I do always like to start off the show here with a uh, breakdown of what kind of we saw happening for the week.
Hmm.
Going to do this a little bit differently, not so many charts, just going to talk about kind of some of the things we see coming at us here, both positive and negative. Really, for the beginning of the year, it's a good time to talk about these kind of
Hmm.
things. So, just quickly though, to review what's here on the chart, kind of a significant time frame right now.
Yep.
Yeah, I mean, this chart goes back to 2021. You can see the big run up there, very smooth in 2021. And then at the end of the year, it started to get a little volatile. November, actually Thanksgiving of 21 is when they started talking about raising rates. And so we hit a high. For our closing high was January 3rd of 2022, right? 47.97 if we round up.
Yep.
Yeah. And so today, we actually went above 47.97 for a little while.
Yeah, we opened the day really hot and then came back
Yeah, we
down.
had a gap up today, probably because of the earnings for the banks were pretty decent or what have you. And then we jumped up to this 48.02, right, just above it. That's what they call an intraday high. So the intraday high was actually set back on the 4th of January
Hmm.
at 48.18. So we haven't broken that yet either. But I put a lot more emphasis on the close. We talk about that all the time. This green line is all closed dots connected together.
Yeah, most of the time when you're looking at prices and stuff like that for long term, you look at the close. You don't look at that inner day.
Yeah, exactly right. And interday does matter, but I think we'll break both of those here. And one of the things that you look for, this is so common, and I've been talking about this since last year. At the end, you get up to these all-time highs. You don't just go sailing right through them,
Yeah.
right? And you can see, we keep bouncing, we bounce down. That little down leg that we had at the very beginning of the year, if you look, the things that were selling off are the things that made the most last year.
Yeah, and it's super common for most professional traders is it to take their profits at the beginning of the year after a good year,
Yep.
because that allows you over the course of the year to then use losses against those gains.
Yeah, exactly right. And uh, the other part that I think is important there too is that when you do take those gains off and you have cash on hand that you
Yep.
want to redeploy right into whatever other stocks, and so you can see a bounce back pretty quickly. And we have, and it's come right back up to where it was. You know, it's very very close today. I took a picture of this chart. As late as I could before the show starts. Matter of fact, we probably should keep watching it to see if we can close above 47.97. But the reason that's important is because historically, when you do get a new high, it can lead to a pretty decent 12-month run.
Yep.
On average, I think 13 out of the 14 last times that this has happened, we've had positive returns. Average rate of return is 13.9%. That's better than the average long-term return, which is about 10.9, 10.8%.
Yeah, the week started off pretty hot with tech running heavily, and then it kind of ran into a wall with the CPI being unexpectedly high.
Yeah, so that's one of the things that happened this week is that the CPI report comes out. It's higher than expected.
Yeah.
Not a lot. For example, on core, it was at 3.9. They expected 3.8. So it was close. And the problem with CPI is number one, the Fed's favored measure of inflation is not CPI. They have talked about the fact that they look at it, of course.
Yeah.
But it has this weird component in it for rents and what they
Yeah.
call owner's equivalent.
Yep. And rents the increase in rents for December were equal to half of the actual core CPI increase. So
Yeah.
it's and a lot of people see rent as kind of a sticky point.
And rents are strange. They're, generally speaking, longer term. Even if rents are coming down on new, existing rentals, you could have a 1-year lease and you're still paying that higher, So it's a weird measure. The PCE, personal consumption expenditure index is the favored measure that comes out from the Fed, and it comes out at the end of the month that the Fed pays much more attention to, and that core right now is at 3.15%.
Hmm.
So today's number that came out that kind of got the market going, probably contributed to that gap up too, was what they call PPI,
Yeah.
the Producer's Price Index, and this is a wholesale inflation. I look at that as more important than CPI to a large degree. Uh, it's a bit more goods based than services, which may not be as accurate in today's economy. but it is sort of a future look. So if the producers are seeing lower inflation, eventually we might see lower inflation on the end product.
Yeah. It has CPI has a lag compared to PCI. So if you kind of like overlay the charts, you can kind of see like this how PCI what was going down before CPI started coming down.
Yeah, and so basically what they're saying now is because of the PPI that came out with a really good number today, is just the fact that we'll probably see PCE get below 3%. It's a projection basis, and that's a big deal. Again, we're trying to drive that down to 2%. But let's talk about some of the the things that are out there right now. What do you see like coming at us in terms of market forces?
So right now we're starting the beginning of fourth quarter earnings, and so anything that's super unexpected could change the market, especially with the bigger companies. So banking came in a little bit soft today. So there's financial or just like banking and ETFs are done pretty poorly today.
Yeah, exactly. So it could be kind of an interesting time frame because you can get all kinds of volatility,
Yeah.
it's weird. I've watched these earnings quarter after quarter after quarter. I think we've had 9 quarters in a row where 75% or more, maybe it's 70% or more of the S&P 500 companies have beaten expectations, and so that's becoming sort of the norm now, right?
Yeah, but it could be that corporations can't take as much profit as they want to. Consumers aren't willing to spend as much money on products, and so we could see some of the service, or at least the good heavy companies coming down.
Yeah, we'll see how it plays out. I mean, one thing that's helped is that the Wall Street has been kind of pessimistic, and so the analysts have had expectations that are too low. I find it kind of ironic that so many companies beat expectations on average. So you kind of wonder about these expectations. They're basically wrong 3/4 of the time.
Yeah.
So or worse. So we'll see how that plays out too. So that's a big one that's coming on. But I do expect in the end to see some bump out of that, mainly because the very end is NVIDIA. And they're always kind of exciting, and all the other pieces that go along with that, with this artificial intelligence component. So what else do you see coming at us this year that you think is important?
So it's a lot about the Fed. How does the Fed handle the rates? Market's seeing many rate cuts, while the Fed's saying we're going to hold rates higher for longer.
Yeah, we just looked before the show. This is called for those of you that are interested, it's called the CME Fed Watch tool, and it shows the futures markets essentially bets on where the Fed funds rate's going to be after each meeting or at each meeting. So there's expected to be no changes whatsoever here in January's meeting. But if you look at that tool, it's basically saying we're going to have a 1/4 point drop at every single meeting for the rest of the year.
Which is another 7 cuts, basically.
7 cuts, right? And now the Fed, when they put out their dot plot, said 3 cuts of 1/4 point each, right, was their projections. And so they're getting a lot of questions all week. And that's been kind of created some volatility in the market in that, they're saying, oh, you're going to reduce rates. Market says you're going to reduce rates in March. And the Fed says, we don't see that.
Yeah.
Right? I happen to agree with the Fed. I'd be surprised if you had 7 rate decreases starting in March, mainly because if you look at the impetus for what would cause that, there's really only 2 main things that would cause rate decreases. Number one, a recession. We're not seeing anything in the numbers right now that's showing recession as a whole. There's pieces of the economy.
Yeah,
right?
there's pieces of the economy lagging, but the broader job market is still strong, and that's important to them.
Yeah, and that's their second mandate is full employment, which they consider really around 4% or better on unemployment, and we're at 3.7 right now.
Yeah,
So
it came back down a little bit.
yeah, so they're probably okay with that. They're feeling like they can keep rates up as long as because they have a dual mandate, right? Get inflation back down to 2% on core PCE, and keep unemployment at 4% or less, right? And so they're there, right? You're getting there. Matter of fact, if you take PCE for the last 6 months, it's about 1%. So if you annualize that, we're at 2%. Actually, we're slightly below it. I think it's 1.87.
Yeah, the last 6 months has been pretty good.
So that's the other reason, though, that rates can come down is deflation, right? So there's inflation when rates go, the prices going up. There's disinflation, which is a weird word that came up here in this whole thing. That basically means prices are going up, but going up slower, like they should. Kind of getting closer to that 2% range. And then there's deflation, where prices are actually dropping. And I've said all week that as consumers, we love deflation.
Yeah, I want something cheaper.
Sure, why not? I mean, if I buy a car, or, whatever it might be, we'd like to see prices dropping. But from a earnings standpoint and from a company standpoint, that's pretty disastrous, because you purchased and assembled, let's say, a car at this price level, expecting to get this amount, and all of a sudden you're getting less.
Yeah, basically you're wrecking your profit margins.
Yes, and that would create problem for the stock market. I know, like Kathy Wood, with the ARK funds, has been talking about the fact that we're facing deflation really since the beginning, and so that's probably more likely why they would be raising and lowering rates, just because I don't see recession coming up in the numbers here for the first 3 to 6 months of the year. Could still happen. I have no problem imagining recession, but I have a problem imagining it here in the shorter term frame. And so we've got the Fed basically, saying, hey, we can't see it. We don't see, what's happening. Now, what could happen before March, though, is if inflation continues to drop at a fast enough rate, they're only going to have, one PCE report before the March meeting, I believe.
No, they'll have
February too, huh?
Yeah, they'll have January and February.
Well, basically they'll have December and January, because it's a month lag.
Yeah.
But so they'll get another data point. Is that enough to make them want to lower rates by a quarter point in the March meeting? That's what the market's saying. So I don't know. So that will cause some consternation for the market because here's what's happened, right? The Fed has historically, without fail, for the most part, unfortunately, they have overraised rates. And they have a really hard job, because when they raise rates, the impact is 3 to 18 months from now.
Yeah,
So
you're turning a dial without knowing the exact where it's going to end.
Oh, yeah. It'd be like turning up the volume, but not hearing what that was for 3 to 18 months.
Yeah, you're not going to hear till the third song, basically.
Yeah,
where it's going to be.
You have no idea how loud it is or how soft it is. And so that's the fear, and that's what the market is struggling with, is that the Fed's track record of over-raising rates is pretty profound. 2000 downturn, we had a 45% downturn. They raised rates 19 times, right? And probably too many in there. And then they're scrambling and lowering rates down to 0 or 1%. And in 2008 downturn, they raised rates 21 times. And again, scrambled back down to 0, created a massive financial, disaster globally. And I know, actually, Chairman Powell gave a speech before all this inflation hit, of trying to change the thought process at the Fed so that they maybe don't create these big worldwide financial crises. I was very hopeful about that, but it was one speech, one period of time. So, we'll see what happens as far as that goes. But the Fed we talk about the Fed a lot. And I know that a lot of people want to talk about the president and the Congress and what have you, but the Fed is more important to the stock market. And so, that's going to be the issue. The market thinks 6, 7 rate cuts. Fed thinks 3. Market thinks March. Fed probably looking at June, July. Second half of the year for these rate cuts. And so, we're going to hear about that a lot too. So what about the election? I've been getting a lot of questions about the 2024 and the possible, really chaos that is coming at us from this election standpoint. Does that have a big factor on the market?
Well, if you're just looking at purely election years, the presidential election years, the market has overall, on a majority basis, has been positive. So that's a good factor for us. We don't know really. It's hard to predict an outcome, and like with the market reacting to something they can't really expect what the answer is going to be.
Yeah, exactly. So there's two points here. One is, what do you do about it, right? We react instead of project. So we could project and say, oh, the market's going to fall apart because of this chaos in the election. We're going to get more defensive. Good luck with that. I'll give you an example. So in 2016, when Trump was elected, it was a bit of a surprise, right? The futures market overnight was down about 800 points on the Dow, right? And so I got up early. I came in here thinking, okay, might get a lot of calls or, want to see what's going to happen. And no calls, market went up. You know? The 6th of January, 2021, and the 7th, the day after, the Capitol invasion or whatever you want to call it, depending on your side of the political spectrum. But nonetheless, the market was up on both of those days. It's not what you would expect. Matter of fact, I had a client in December of 2020 talking about what she saw coming in terms of potential violence, and she was very nervous about what that was going to mean for the market. And it didn't mean anything to the market in the end. It's important in other areas, and maybe long term, there's some political ramifications. So I would say that we kind of have to just, play it by ear with what happens here on the political spectrum and see what type of impact that has. But I'll tell you, that statement I just made is not what people are thinking.
No, people have recent memories of pretty much the chaos of election year, but
Well, but they attach very, very, very strongly politics, Congress, who has the White House with the stock market. And I'm saying, and I've been doing this for my whole life. Started doing this when I was 12 years old. I'm 59 now. The correlation between, especially in the shorter term, in the memory that you might have, the next 12 months or 36 months, between who is in Congress and who is the president, isn't that strong. The Federal Reserve and what they're doing with monetary policy, interest rate increases, quantitative tightening, quantitative easing, you can make very direct correlations with that, and
yeah,
even on a day-to-day basis.
the only time I'd say Congress or the president comes into play is when you have actual bills that get passed, whether it be a tax cut. So tax cuts, the 2017 tax cuts,
Right.
definitely corporations, flew off of it. It had it up from that.
We had a nice run, and actually you could probably blame that last big COVID bill that came in early 2021 with the spike in inflation. It might have been the piece that pushed us across. It's hard to tell. Can't go back and take that out. But if you look at the inflation chart, it took off right after that money was pushed out the door. So that's something that came politically. There's things that do happen, and there are some correlations there. I mean, I was talking to a client the other day, and the current administration, I think the Fed so far has done a really good job. And I think Chairman Powell has done a really good job communicating. And he was actually appointed by Trump and then decided again to be appointed by Biden, or the administration anyway. And I think that's something that happens by whoever's in office. I think Yellen personally has done a decent job as Treasury Secretary. She used to be Fed governor also, which I think is an interesting role. So there are some pieces, but I don't know that this election's going to be, and what might come from that might be the biggest issues.
I don't think the actual election is going to change anything. It's if what comes from the election. So whatever legislation is passed, but you won't have movement until those bills are actually passed.
Always ask yourself, in my opinion, how does this impact company earnings, right? And I think what's happening in the Red Sea potentially has more chance to impact company earnings than what might happen in our presidential election. Now, I actually think the Red Sea is probably going to blow over. You're talking about, is Houthi, I believe is how you say it, right? Not a huge group with lots of power. The U.S. and U.K. are launching, retaliatory strikes as we speak, and all this stuff. But the concept of the Red Sea is that 15% of world commerce goes through the Red Sea. So if somehow you cut that off, you have a situation where supply dries up, and when supply goes down and demand stays the same, prices will go up, and we're already in an inflationary environment.
Yeah, you have to think about what goods goes through that passage. Oil is a very prominent one.
Yeah.
I know a lot of Chinese trade to Europe goes through that Red Sea. So you have to think about what companies will be affected.
And oil is just a dramatic asset, right? I mean, because if it goes up in price, it's at like $70 a barrel right now, so it's really, really a good price. Was at 130 right after the Ukraine invasion, but it has that capability of creating some higher inflation really quickly, because it's not only powering our cars, and for the most part, but it's powering all the trucks and trains and everything that's getting the products and goods to you. And so when that goes up, it can kind of be, an inflationary spike. And if you look at what happened in the 70s, that was, we looked at that chart some time ago on the show. It went from $4 a barrel to $40 a barrel over a 7-year period.
Hmm.
That's going to create inflation. So those types of things are, we always watch out for and see how that plays out. I don't think it'll be a big deal. Normally conflicts, I actually thought the Ukraine would be a bigger deal, at least with the price of oil. A lot of people talking about oil going to $200 a barrel at that time. Yeah, I saw one lady talking about an oil analyst going to 260. If we were at 260 right now, our inflation rate probably wouldn't be
Yeah.
coming down, right? I mean, it would be a problem. So uh, the issue with oil, though, that has changed dramatically is that the U.S. produces so much oil now themselves. We're actually a net exporter of oil, and so that's been much more difficult for OPEC or any of these conflicts to really create a higher oil price. So we're in a different spot than we used to be. So, okay, so I think those are some main things that are coming at us, with the Fed, with international conflict, dealing with the presidential election. These are things that are happening. Uh, I think we're going to break into a new high. It's taken us a little bit of time. Um, we do want to watch out for that double top.
Yeah.
But if you look at most double tops, they're not quite like that. Matter of fact, if you look at the top that we had, see how it just kind of didn't spend much time there, and it's
Yeah.
pretty steep on each side. That's more what a double top looks like. When you start continuing to hit it over and over really close,
Yeah.
that means you're probably breaking through. I mean, there's a signal here. Even yesterday, the market's down 0.8% and then rallied all the way back up to essentially even, right? That's just, there's this power. It just wants to go. And I think it will break through and go as far as that goes. But that's, probably a little bit of run from that if we get through there
Hmm.
also.
Yeah.
Things are pretty good. We're still a little stretched out, that big run we had. There's some pieces that'll slow us down, but overall, I think, the Fed motion to lower rates or stop raising them is a really big boon to the stock market. Historically, it has been anyway. All right, that's good. All right, so thank you for joining us for our summary for what we kind of saw happening. We're going to answer some of the questions that have come up either in our, client interactions or client strategy sessions or come in live here.